how to better manage my time and working towards putting a team together, because I know with where I'd like to go, we want to build this up within our family.
Awesome. What have you tried before?
Been doing buying houses and rehabbing, not to flip, but buying whole. So I'd buy things and fix them up and hold on to them long term as rentals.
What's the biggest takeaway you've gotten this meeting so far?
Getting some knowledge about how, really, I think some time blocking and getting some accountability. Some people I need we need to keep each other in check in on each other, and make sure we're staying on our targets instead of trying to do it all alone.
Awesome. If someone was thinking of coming to one of these events, what would you tell them?
If you're serious about it and you're really wanting to get into real estate at a level worth doing, by all means, the knowledge is power. And this is such a group of people that there's so much knowledge, and not just the knowledge, genuine people who want to see you do well. Yeah, that's priceless. You can't put a price on that.
All right.
You've seen what other people have had to say. Now it's time for you.
What's going on, everyone? Welcome to the Opportunity Zone on this amazing Tuesday. If you're new to our world, my name is Steve Warner, and I'm joined by Nate Armstrong. Let's pull Nate up here. Nate is the founder and CEO of Home Invest. Great looking jacket today. How are you doing this week, Nate?
Fantastic. Steve, that is a mustache.
Dude, it is, everyone's been asking about the mustache. It is Men's Health Month. If you guys do not know this, it is Men's Health Month, so I'm rocking my inner Magnum PI. Somebody called me Magnum PI last night, and I thought that was pretty funny. It made my day.
Beautiful. Beautiful. I love it, man.
So we are supporting Men's Health. That is a different show altogether. Today, though, we have a lot to talk about. Dude, markets went through the roof all because of the election. We're going to be getting into what that means for you guys. So Trump's plan moving forward with real estate, he's put out a few details around that. We're going to be talking about what that looks like, what the economy is doing right now. We're also going to be talking about single family. So Nate, Opendoor, some big movement at Opendoor and single family. What do you think?
Well, I find it interesting. I'm going to pop that article up for everybody to see this because, or do you want to do that in a little bit?
We'll wait. You got to leave them on the edge of their seat a little bit.
Well, the fact that they've lost money for the last 3 quarters says a lot, but now they're to the point now where they're cutting people. And why? What's going on with the housing market? Well, we'll talk about that in a couple of minutes.
Yeah, we are going to be diving deep into the housing market, both single and multifamily. It's pretty interesting. There was actually a report with some data. If you like data and graphs, I know Nate does. We're going to be covering some of that around multifamily. Some of the stuff, we're going to jump into the geeky side of it. We're also going to be teaching you guys a little something. A lot of people ask us, like, how do I get involved in single family? How do I get involved in multifamily? We actually have a 2-day event coming up Friday and Saturday. Nate, what are we going to be covering in that event? It's not single family. It's going to be multifamily. What are we going to be covering?
Yeah, and what everyone has to understand is that the opportunity today, it's really in multifamily. Or I suppose if you're an office pioneer and you want to go through the curve of office could be some good opportunity, but multifamily is hit bottom and it's coming back up. It historically does not go down very much. 2009 was the last time that it went down, and right now it's down. Like, this is the window to buy multifamily. So what are we teaching? We're teaching how to find them, how to fund them, and how to manage them. So those of you that are like trying to figure out, how do I land my killer off-market multifamily commercial deal? This is for you. If you're trying to figure out, how do I raise the capital for it? This is for you. If you're trying to figure out, how do I actually manage this long-term so I can hit the returns that I projected to hit? then this is for you. That's going down Friday and Saturday this week.
There's a lot going on. We are going to make sure that you have the link. I actually did not have the link ready for that, Nate. If we have the link, we do charge for this event. It is because we give away as much value as we can. Nate, how much is the investment for this?
It's only $247. And literally with it, people get we have this magic calculator that we probably have 10,000 plus hours into screening deals over the last decade. We've got the calculator, we've got a bank list. There's a whole bunch of other goodies that come with it. And we're contributing a sizable amount of this proceeds over to Home Invest Kids. So it's going towards helping people that really need it.
Nice. All right. We will make sure we get that link up there. We're going to be teaching you a little bit here about single family. If you are more like, hey, what's going on with single family? We are going to be talking a little bit about single family. We're going to go through the script that we use and the difference between a wrap and a subject to, all of that on today's show. But we like to start things off here at Home Invest a little different. Nate, how do we start everything at Home Invest?
So two things that I want to hit, and actually I'm going to put the ticket link up there, the right one. I put the wrong one. So I put the ticket link, and those of you that are following us online, if you can't find it, just put ticket in the comments and our team will hook you up with a ticket link for it. And so how do we start? We start with prayer. And I want to just give everybody a little bit of interflexion for a minute, something to think about today. Most of us might remember a spot in the Bible, specifically when Abraham and his nephew Lot, they're overlooking the region. They come to the conclusion that their teams can no longer share the same piece of land. They have to separate. It's not that Abraham and Lot don't get along. They do. It's that their teams, all the folks that are working for them, they're not getting along. So they come to the conclusion they have to separate. And Abram looks at Lot. Abram's the senior. He would have been the leader up until this point. This is the important part. He says, Lot, you choose first. Where do you want to take the land? And remember on this part, Lot looks around and he sees over there, he sees that there's water. He sees that there's a city nearby called Sodom. And he thinks to himself, yeah, I need the water for my crop, my livestock. And I also, that city being right next door, I might not have to sleep in a tent anymore. I might be able to sleep in the city. And so he chooses that. He's thinking about his profit first. Now, if you fast forward, history is kind of hindsight. We realize that was a dumb move. He gets literally kidnapped at one point, and then later on in the story, we learn that Sodom and Gomorrah literally basically melt to the ground in the future. And we realize that was a very bad move. He loses all of his wealth. Sometimes we take investment decisions up front, like Lot did, based on our gut feel, or maybe the conviction that we think it's going to make more money. But remember, in the end of that story, who made more money? Who grew their wealth more? Was it Lot who chose first, or was it Abram? I'll leave you with that just for some little self-reflection on this, and we'll circle back towards that towards the end of this broadcast as well. Dear Lord, thank you for this opportunity. We're coming together with some brilliant investors. Please just let the questions flow. Let people really get what they need out of this broadcast. Let Steve have the words to help people see whatever it is when it comes to finding these killer deals, to funding them, to any part of this. Just let us have the right words for everyone today. In your name we pray. Amen.
Amen. Nate, I love the Bible story. I was actually looking up. I was trying to find a picture to put on the screen. We normally tell the story of Matthew 25, which is all about the talents and being a great steward of what God has given you. And we have some awesome old school Bible school stuff, but I couldn't find one fast enough. So as we jump into the teaching, we do like to share a little bit about the deals that we offer. Our whole goal here at Home Invest is to help you be great stewards of what God has given you. If you are an accredited investor looking to invest and grow your wealth into generational wealth, we put deals forward that will help you do just that. And the one that we have right now is absolutely phenomenal. We actually call it one of our infinite investing models, because you're going to invest with us. We're going to go into the deal together. We're going to grow our money. We're going to refinance the deal. And this is where most syndicators would cash out their investors and take the rest of the profit for themselves. But here at Home Invest, we like to keep you in the deal. Nate, do you want to share some of the details around this deal?
Yeah, with pleasure. And I need your help in the chat for this section because I need you to help me answer a couple of questions on this. So first, if you invest in a deal and at the end of the year, let's just say you invest $100,000 and at the end of the year, you make 10 grand, what is your ROI? Type that in the chat for me. If you invest $100,000 and at the end of the year, you end up getting $10,000 back, what is your return on investment? I want to make sure that we calibrate on this one because before I put this deal up, this is not a usual deal. You will not find these commonplace in the market. It's almost like the rhinoceros, the white rhinoceros. It's one of those rare finds. So when you put in 100 grand and you get back 10 grand, what is your ROI? Bruce, you're ahead of the curve. You're ahead of the curve. I like you. You're bright. This is a good group. So if you put in 100 and you get 10 grand back, you make 10%. Let's just say that you put in 100, you get all 100 back at the end of the year, and you make 10,000 in rents. Then what is the return on investment? You put in a $100,000 investment. At the end of the year, the team that's doing the investment, they're able to get your money back to you, and you make 10 grand on top of that. What is your ROI on that deal? What is the rate of return? JP, you nailed it. Bruce, you're accurate. Infinite, yes. How about this? Year 2, same deal. Year 2, you already got all your money back on year number 1. Year 2, rents go up. Now you make 12 grand. Year 3, rents go up again. You make 13 grand. Year 4, rents go up again. You make 15 grand. Year 5, rents go up again. You make more. What is your ROI then? And it's still infinite. Bruce says that's way infinite. Yes, you're exactly right. That's why it's infinite. Yes, you're spot on. Now I know the financial. Yes, the financial guru. They won't show you on a calculator what infinite looks like, but in our definition, that's what infinite looks like. When you can get your money back and then still have cash flow coming every single year, every single quarter, that's infinite. So the deal that we have right now, it's a deal that's structured like that. So what is it? It is a beautiful multifamily property in Oklahoma City. Oklahoma City is a very landlord-friendly state. It is booming right now, jobs galore. In fact, it's right next to the Tinker Air Force Base, and the biggest jet engine producer in that region. They just announced that they're expanding their facility. They're putting $255 million into that facility 6 minutes away from this property. Like there's expansion happening right now because that little Air Force base is booming right now. It's the most important Air Force base in the country, in my opinion. If you look at the broader demographics of like what's happening with population, Oklahoma City is growing. They keep hitting the charts for one of the fastest growing. They are growing faster than most of the United States is right now. Oklahoma City, it's got this little magnet that's just attracting people there for jobs, and it's very affordable living. The Southeast has started to taper off. We're not seeing the tremendous growth in Florida like we were 2 years ago during COVID. Nowadays, Oklahoma City is outpacing it. So for those reasons, it's a pretty interesting little deal. The property itself, I'll get into it in just a second, but the seller on it, we started negotiating with him a year ago and he died. He was suffering from cancer and he let the place get really dated. So I'm going to show some pictures of it and what we're doing for the transformation to it. But like you can see this picture right here, older, dated, basically just needs updates. And here's what we're going to go in and do. We're going to go in and update it to a good C-class type property. It's nothing fancy, but this is really good for the area. So when I show you images of the property, just know that like it's dated, it needs some love. And it's part of the reason why we're buying it so unbelievably cheap. We're getting it at a massive discount. In fact, we just got the appraisal back on Friday, and it shows that we have immediate equity upon purchasing. Usually appraisers don't really do that, but this appraiser recognized how much lower we're buying it than market value. The big upside for us is this. Right now, it's rented at $1.08 per square foot, which is really low for the area. The area, if you go around and look at the neighboring properties, which we did, it's about $1.35 per square foot. we've got almost a 20% delta, big gap right there where we can come in and add value to the property. So we'll go in, we'll spruce up the property unit by unit as tenants turn over and whatnot. We're going to do roughly 11 units right out of the gates. And then the other ones are on a case by case basis. And we're going to increase rents to market rate rent. We believe that when people invest with us in this deal, we'll be able to go to the bank within 24 months and do a refinance. That's how we pull the cash back. That's how we're able to return capital to investors and still share the profits on it. The way that the economics work on this deal, if you're interested, if you're like, hey, this sounds kind of interesting to me, I want to learn more about it, then the way it works is that if you're investing $100,000, you can get a 6% preferred return and you split the profit with us 70-30. Means you get 70%, we get 30% as the management team. The second way is folks that put in $500K or more, you get an 8% preferred return and you get 75% of the profit. And then the third tier is folks that put in $1 million or more qualifies for a 10% preferred return and an 80-20 split, 80% in favor of you, the investor. That's kind of how it goes. If you're wondering like, well, hey, why do you guys even do these? Why do you split profits with people and all that kind of stuff? We do invest our own money into these deals. The reason we bring investors in is so we're able to do more projects like this per year. We get financially incentivized by getting this split. That's the biggest motivator for us. And we also get some fees. We get an acquisition fee on the deal, kind of like a real estate agent or a broker would to get paid on a deal. But when you look at a deal where we can make 20 to 30% equity, that's good upside for us. And it's reason for us to employ our team to go out and take down these deals. There are not many like this. This is the last one of 2024. If you are looking for a real estate deal to get some tax benefits from, to get some income from, to refinance your cash back and get it all back and still get dividends from, this is the last one of 2024. There's not enough time to close on another one. With that said, if we could just throw the link in the chat, book a 15-minute phone call with our team, and we're happy to go through the details with you.
Sue got the link in the chat. So what's going to happen if you're a accredited investor? There was a question on this in the chat. So it is not our rules. This is the government's rules. They say that you have to be accredited in order to invest in a deal like this. So that is why you have to be accredited. It is not our rule. It is the government's. Accredited means you make more than $200,000 a year singly, $300,000 a year jointly, or you have more than $1 million net worth, not including your primary residence. If you fit those, click the link that is in the chat. Myself, Sue, Doug, we're all here. We'd love to have a chat with you. It is not a high pressure sales call by any means. We would much rather just have a conversation with you about what your goals are, how you can reach financial freedom. We'll show you a little bit around the deal. If it's something that works for you, great. If you just have questions about syndications, we're also happy to talk to you about that. Because honestly, I don't care whether you invest with us or if you invest with somebody else out there. If you are taking action on building generational wealth, you're moving in the right direction. This is an absolutely phenomenal deal, though. It is one of those deals that people dream about getting into because it's going to pay you for years and years to come, and you're going to get your capital back when we refinance. So Nate, thank you so much for sharing. If you guys can tell, we're pretty passionate about this stuff. All right, you ready to dive into the news?
Let's hit it, man.
And okay, so first off, I want to know, what were you doing last week on election day? Were you watching till the bitter end? The bitter end. Were you watching till the end, or did you? What was going on with Nate? Because Nate was pretty excited about the election.
I watched until roughly 9 o'clock, and then I went to bed, and then I woke up at 1 o'clock to see the status. So I did have an aches to get up and check. I had to check.
Nice. And then did you still get up at 4 and go to CrossFit?
Yeah. Got up early. I've been running a lot though. I haven't been going to the CrossFit gym as much. I've been putting on a lot of miles.
Got it. Nice. Well, I'm sure it was exciting for you. I know we're going to get into the Trump stuff, but let's start. I want to start in single family. And let's start with Opendoor. So first off, let's tell people what Opendoor is. Why is Opendoor Capital an important thing?
Yeah, think of anyone that's ever done a flip before, where you bought a house, fixed it, and sold it, flipping that whole business, flip that house, all the TV shows. Open Door was really the first professional company to do it at a level that they went public. They raised a whole bunch of seed capital, roughly 2013. By 2014, they opened on the New York Stock Exchange and they started flipping 50 to 500 houses per month. And so they've been doing the flipping business at scale. Nowadays, you can go to opendoor.com, depending on what city you're in, and you could sell your house to this company and they could literally buy it almost sight unseen. They do send somebody out there to come inspect it, but almost sight unseen. And so they kind of carved a new path, and they were flipping all the way from 14 up to about 2020, making really, really good money. And the last year or so hasn't been the case. Last year or so, they've been getting beat up, but that's what Open Door is as a company.
Okay, so let's bring it back to then what has happened over the last year.
Yeah, it's basically loss after loss after loss. So as you guys know, the housing market, most buyers are on strike right now. The interest rates went really high. And I know you might say, well, Nate, hold on. My market, the house prices are still high. And I get that. I hear you there. But the reality is that not many transactions are happening. It is slow. And I say that with an emphasis intentionally because this is the slowest the housing market has been in a couple of decades. This is eerily slow. This is how slow it gets usually before prices dip. And so we're going through that right now. So Open Door was still acquiring. They were still buying business as normal. I'm sure they adjusted their prices a little bit, but they obviously didn't adjust enough because they just lost $78 million in the last quarter. And this is a 14% cut from the previous quarter. So that means the previous quarter, they lost even more money. So this has been going on now for the last year, losing money on each quarter after quarter.
So losing money quarter after quarter, they're cutting people. They laid off 300 people.
And that's almost a quarter of their company. Like they just shed almost a quarter of their company, cut them.
What do you see continuing to happen for them? I mean, usually when companies start making cuts like this is the first, I think we've got 2 or 3 months, January, start to see another one. Is there a world where they recover? What's going on?
Yeah, there is. If we just go back and look at history, look at the last downturn. Downturn started in 2008. By 2010, we really felt it in the housing market almost 2 years later. And we kind of hit bottom in 2011, maybe 2012, depending on what city we're talking about. And then we started to recover from there. The housing market only has 2 choices, in my opinion. Choice number 1 is prices have to come down to get buyers to come back. Buyers are on strike. They are on strike. Choice number 2 is that wages have to go up. Okay, there is a third option, and this is geek talk now. The third option is that we go through a flat period for a long time, like we did in the late 70s, early 80s, and that is a potential too. But more than likely, either prices have to come down in single family or wages have to go up. That's the only way buyers are going to come back, because with mortgage rates where they are, even though they've come down a little bit, they're just too high for the average person to go afford a house. The American dream of buying a house when you're, let's just say, first out of school, it's dead right now. It's not happening. That's why buyers are on strike.
All right. So that's going to lead us into the Trump plan. First off, the economy reacted to Trump wins. Let me pull this one up. Markets went nuts. Nate, I know you watch this stuff really closely. I'm pulling up my share right now. So markets reacted really well to this. Am I sharing the correct one? Give me a thumbs up if I'm.
Yeah. Here's why
Windows.
Trump's swing cent dollar. Yeah. Yep.
So let's talk about what happened. Why did bond markets go nuts? Why did everything take off?
Well, I sent this text message at 6:37 a.m. on Wednesday last week. So this is right after the election. And the text message is in fine print, so I'll just read it. It says, I'm lacing up my running shoes. I sent this to some partners. I'm lacing up my running shoes. We just got pro-business government trifecta. What it means is that we already know what the plan will be for the next 4 years. And it's going to be very pro-business. It's going to be pro-real estate. This is a real estate developer that is taking office again with an agenda to cut regulations and to make things go, make the economy roar. So it's my firm belief that we're going to roar. That's why the markets are already reacting. We're already seeing people with stock prices surging high, crypto prices surging high to record highs. Like everyone is anticipating that the United States economy is about to really awaken again.
Yeah, I have to say I was very shocked. I don't have a ton, but I have a little bit left in Bitcoin that I held just because I believe in Bit. And it 25% return in a week. Pretty nice. I mean, I will see if it holds, but it was pretty shocking. I figured that things would do really well. But it was pretty interesting to see. I mean, the next piece of this, so how will Trump's victory specifically affect multifamily? So Nate, you said this already. We know some of the things that are in store. So one is the Jobs Act. What do you think we're going to see with the Jobs Act? I mean, he's talked about it a little bit.
Yeah, I'm going to reference a speech he did 2 months ago. He was literally at the New York Economic Club. You could Google search that if you want to see the full thing. It's like an hour and a half. And in that speech, he's talking about what this country needs. Right now, we've got housing shortages still, yet we have a government that's full of red tape. Did you know, question for everybody, did you know that between impact fees, survey costs, permit costs, to build something new real estate development, up to 25% of the costs can go to just those fees up front. Basically, red tape, regulation stuff, regulation requirements, architectural plans being submitted. 25%. That's massive. That's a huge uptick. And so Trump was talking about, how do we cut that? How do we make that more affordable for the developer to actually want to step up and say, you know what, I'm going to take this risk. I'm going to develop this land and build this beautiful piece of real estate. So he's talked a lot about deregulating. How do we cut that down? He also talked about opening up federal land. The United States government is a country that has more federal land than a lot of countries do in the world. And could we open some of that federal land to build some new buildings on? So he talked about that. He talked a little bit about taxes, the Tax Cuts and Jobs Act. I suspect it's on the table for it to come back again in full force next year. It won't help you this year, unfortunately. This year, it's November 12th at the time that we're doing this broadcast. As of now, you got a little bit of time left to still get some major tax advantages. But come next year, even if he does something next year, you can't take advantage of it for tax year 2024. The only way you can take advantage of 2024 is if you take action now, this year. So although I do believe in the future, we're going to get more tax benefits from him. Right now, we have to take advantage of what's on the table, which is it's at 60% bonus depreciation, which is still pretty massive. So I think those are the big ways.
If you guys need a tax break for this year, I know we're getting to the end of the year, reach out to us. You can click the link, Sue, if you want to put that link back in the chat. If you guys need a tax break for this year, the deal that we have on the table right now, Nate, what's the depreciation? What did the cost seg study show on that?
Yes, we've got, so the one deal that I put up right there is the only deal that we have left that we're going to fund. We have one more that we closed on a few weeks ago that we could probably take some capital in. We would sell some of our existing placements. If someone really needs a tax benefit, we have one deal right now that people could get up to 50%. There's some qualifiers for it and all that kind of stuff, but no, there's no free lunch, obviously, with the IRS. But if you need a tax break, if you're like, hey, I want to invest in a multifamily specifically so that I can get 50 cents on the dollar back, then reach out to our team and ask our team about our tax deal. And we've got a deal that would size up nice for people looking for tax benefits.
Awesome. I want to share this article one more time because I want to talk about some of the other things that it says in here. I'd love to get your reaction to it as well, Nate. So first, reducing mortgage rates, lowering inflation. We've heard about that. Opening federal land. You talked about that. The other things, cutting housing regulations, which would make housing less expensive to build. You touched on that one. And a ban on mortgages for undocumented immigrants. This is actually the opposite of what we're seeing in California right now, which I think honestly would be more impactful than the wall. You can take that however you want. I'm not a huge fan of building the wall, but I do understand. I think he's got a lot going on, and I think that it means a lot for multifamily. It is completely the opposite of what Biden laid out. If you guys read this article, like down here, it kind of talks about it's the exact opposite, right? We're not talking about rent caps. We're talking about how do we actually build more housing and make more housing affordable, both in single and in multifamily, which I think is an exciting time. It's good to see what's going to happen. So definitely looking forward to that.
The last bullet on there, Steve, about mortgages not being eligible for undocumented individuals in the United States. I think it was prompted because of what we're seeing in California. They tried to pass a law. It failed ultimately, but just a few weeks ago, they tried to pass a law that undocumented persons in California could get a mortgage. And additionally, there was a grant, a down payment grant for 45 grand that they would get essentially for free. And so it was like a zero down mortgage situation. So I'm glad that he kind of steps up and says no to that, because FHA, remember, the primary loan provider, like if you go to US Bank, Wells Fargo, Chase, if you get a home mortgage, they're selling it to Fannie Mae 90% of the time. And that FHA company is still government backed. That's your tax dollars. So whether you like it or not, like if they were to pass what they had in California, undocumented aliens getting mortgages, you're funding it with tax dollars. So I'm glad that he's actually stepping up saying, no, we're not going to do that.
Yeah. All right, Nate, that brings us to our last one. This one's a little bit more data heavy. Not too much, though. We don't want to put any of you guys to sleep. Instead, we're just here to share. Multifamily market turns the corner. Vacancy rates decline. We are now, if you follow this through, there's a bunch of numbers in here, but we are 72% above the pre-pandemic number, which means there are a lot of people living in multifamily. Multifamily is on the rise. We've been talking about this for a while. During a recession, when things get tight, people tend to move into multifamily. They get out of their houses and they move into something that is cheaper. All of the data here in this article talks about that. Nate, I know that you've seen this coming for a while. We've been talking about it for a while. I don't know if you had a chance to dig into some of the numbers here. What does this mean for multifamily moving forward?
Multifamily, we're going to go through this year, probably next 12 months, in markets where there's a lot of new deliveries happening, meaning new construction. Not talking about Amazon deliveries. I'm talking about builders that built brand new apartment buildings. When those come on the market, they affect the whole metro area, especially in that neighborhood, because they usually offer heavy discounts, heavy incentives, free rent specials, things like that. And they're the newest building in town. So everybody around it gets affected. But come a year from today, those deliveries, not Amazon deliveries, but new construction deliveries, they come to a stop, a screeching halt. So I believe that a year from today, we're going to be talking more and more about rent increases happening. Rents are going to have continued upward pressure. Even right now, in the article that you have, Steve, it says the Northwest, Midwest, and Pacific regions recorded positive year-over-year rent growth. The Midwest led the chart with 2.7% growth, followed by the Northeast. So even while they're still talking about all these new deliveries coming and things like that, we're already seeing rent growth, even in the midst of the new construction deliveries happening. The reason, if you're wondering why we're going to have no new deliveries in a year, is because they take about 2 years, sometimes 3 years from start to finish to complete. And when interest rates went sky high, which they have been the last 2 years, builders just stopped. They said, I'm not going to go take debt to go build a new multifamily property. No way. I got to step to the sidelines. So all the builders for multifamily, they stepped aside. And all that you're seeing right now being delivered is stuff that was started before interest rates went sky high. That's why I believe a year from today, the rents are going to go up even more.
So rents are going to go up more, and we're going to see less overall. We're going to see the market constrict a little bit because there's not going to be as much inventory, which means there will be fewer deals, but the deals that you can find will probably be good because a lot of people are going to be looking for rentals. And if you guys are looking for a phenomenal deal right now with tax benefits and infinite banking, Nate, do you want to run through our deal one more time?
Yeah. I'm going to specifically hit this. So like when you look at multifamily property, I don't care if it's our deal or anybody else's deal. The first thing that you should do as an individual investor is you should look for growth in the area on jobs and population. Growth on jobs and population. Always remember that. If you don't remember anything else, remember growth of jobs and population. Because if you've got growth of jobs and population, it's going to put upward pressure on rents. That means that even if you buy a bad deal in a market that's got growth for jobs and population, even a bad deal ends up looking good because rents are going up the whole time. The opposite is true as well. If you end up getting the best looking property in the world, it's this pretty beautiful thing, but it's in a market that's declining. There's people moving out. I'll give you an example of it. Detroit, 2008, 2009. Detroit, that was a rough place. You could steal houses. We bought a couple single family houses for $15,000 up in Detroit during that time. But guess what? When it came to renting it out, the market was still deflating. People were moving. And so even though it might be the prettiest deal in the world, if it's in a market that's not growing, not a good deal. So the very first thing you do is always look for growth in jobs, growth in population. And so the reason that I'm the most excited about this deal, outside of, I'm putting in money on this deal too, outside of me getting that money back in a short window of time and collecting rent potentially for the rest of my life, I'm more excited about the fact that you've got a huge employer 6 minutes away recommitting $255 million into this market. And they've got other ancillary recommitting folks that support that, support those more support jobs around that. And then I'm also really excited about the population growth. When I see a market that's growing faster than the average growth of the United States of America, which this is almost double the United States of America growth, that's a really good thing. That just tells me straight up, we're going to have no problem renting this place. We're going to have no problem growing rents. And therefore, I feel good about parking my capital in that one. So that particular deal, it's open right now. It'll close relatively quickly. The last time that we published a deal like this, we raised all of the capital in 8 days. So if you're looking for a deal like this one, then make sure you book a call with us. Let's chat it out and see if we can help one another on this particular deal. And then we'll close this one up. And that's the last one for 2024. I might have froze on you, Steve. Either you or me froze.
Steve froze.
I think I froze. My internet, it says my internet is unstable.
It's got to be the
What's that
mustache.
brown
Steve.
stuff above your mouth?
That's it. It's the mustache. It's slowing him down. That's what it is here. We're all going to give him a hard time about that. Steve said it's because of Men's Health Week. Men's Health Week. He's displaying his inner manliness. Cool. Well, Steve's internet is out of commission, so you're stuck with myself, Sue, and we're going to put Ralph on the beach. We're going to broadcast him too. All right, guys. Sue, is there anything else that I should have hit this week that I didn't yet?
No, my phone's been ringing off the hook. I sent out a reminder yesterday to all my investors. I said the election's over. It's time to do your investments by the end of the year. So people are coming out of the woodwork now. So if you guys are interested, book a call.
That's what always happens. And I hate to be like a stickler on, hey, plan your moves in advance, but every single year, I remember last year, even Christmas week, I had an investor call me and say, hey, Nate, can I still get in a deal? I need some tax write-offs. My CPA just said I'm going to have a huge tax liability. I need a tax write-off. And we had to say no because that was CKW at that point. We had just filled it. And so if you're someone that you're going to have to write a check to Uncle Sam this year, plan ahead. Do a call with your CPA, do a call with our team, and start to make moves where you could potentially not have to write a check to the IRS. That's what we do. That's most of I call it the smart money, folks that are investing $500,000 or more. Usually they're making moves this time of year. November is their time to plant all their capital and mitigate all of their potential tax liabilities. So if you want to not pay the IRS and instead get a nice investment property, then now's your chance to make your moves.
I
Sue,
was
we're-
so thrilled with my taxes this year. Oops, am I muted? Oh,
Oh,
I
you're
was
good.
so thrilled with my taxes. You know, we postponed it because we didn't get the K-1s until later, but I paid $10,000 in advance on my taxes, and I'm getting a $1,000 refund. You know, so it's just CKW helped me a ton. I invested 100,000. The tax write-off was 41,800. And then I had Hartford and a couple other little ones. So I was so thrilled. So,
That's awesome. It's awesome. Yes, I don't think it's an accident. If you look in the Bible of where the parable of the talents is, that's Jesus basically saying, hey, go out there and double money. That's my interpretation in a high level. But he tells it right after he talks to a tax collector. And a lot of people forget that placement, but I think it was a little bit intentional. He's just got done meeting with the tax collector, and then he tells that story. So I think that we need to be mindful about what we're giving to the tax man. Do what Sue does. Don't pay the tax man so much money. All right, guys, that is a wrap for this week. For those of you that are joining us this weekend on Friday and Saturday, we look forward to having you. If you need that link, it is in the chat. CJ, could you post it publicly for everybody, the link for this weekend? And that way there people can get in still if they want to get in. And if you're looking for a call with our team to talk about our investments, that is a link from Sue. We'll post that one more time in the chat as well. As soon as we close this call, all the links disappear. So make sure you click on the link now before we actually close out. Okay, and if you're following us online and you don't see the link, just message us the link. Just say right in the comments, write the word link, and our team will send it over to you via direct message. Okay. Thanks, guys. We appreciate you. Have a good rest of your week.
bye,
Bye.
everyone.